Good day, students. Welcome to the class once again, and we are really very excited about finishing this course. We are almost at the fag end of the course right now, and we've talked about a lot of things about investment analysis and portfolio management. Right now, we're going to be talking a little bit about what we thought about the investment process and how are we going to formulate the investment policy. And we discussed that we need to find out the objectives, the constraints, the preferences of each investor, which are very different from each other. So what is required is that we need to understand what the objectives are, the return requirements, the values and the risk tolerance of each individual investor. Also, we need to understand what are the constraints, what are the preferences, what sort of an investment does an investor like, what does he want to avoid, what is the time horizon, what does he think about the tax laws, and what are the constraints in liquidity. These are things that we need to know before we can actually make up a portfolio for somebody. We need to understand that in these investment policies, there should be some sort of a statement about inflation. The investor would probably focus on inflation. We must understand there are certain problems for the investors if we do not let him know much about inflations and taxes. But we must also let the investor know that the common stock is actually not always a good inflation hedge, because the common stocks have their own inbuilt, inherent risky situations. So maybe we should also blend in some other things. So there are unique need circumstances which then may restrict the portfolio manager to avoid certain asset classes. We can't put in all the asset classes because of some sort of constraint on behalf of an investor. Maybe he is not very keen on taking too much risk, or maybe he doesn't have that sort of time to look for a very soft portfolio. So we must look at the time constraints and how long is an investor going to be around to look at the fruits of the labor of portfolio management, or when would an investor actually be needing to cash out on the portfolio, and when would the requirements be for him to look at the portfolio to be cashable. Those timings have to be precise. Tax considerations can also be an impact. Maybe there are double taxations, so we can look at ordinary income tax and capital gains. So maybe the dividend aspect would not be very exciting, but the capital gain aspect would be very interesting. So we could look at aspects of different requirements for each individual investor, and then we can understand how these things can be formulated into a good portfolio by looking also at the legal and regulatory requirements as well. So a prudent man's rule would be to be followed in fiduciary responsibility, and interpretation can change with time and circumstances. These all will depend how the investor feels about the market. So the standard applied to individual is that investments rather than the portfolio as a whole should be considered. Plus, we understand that diversification and standards are applied to the entire portfolio. We're talking about portfolios. We're not talking about 1, 2, or 3, 4 individual scripts. We're looking at the portfolio as a basket for needs of an investor. Maybe double taxation will not excite him because he'll feel it's being an unfair practice to have taxations at the end of the corporation, and then dividends are paid out and then he's taxed again. It is one ambiguous situation in which the capital market is quite worried about double taxations, and investors shy away from companies who just pay out cash dividends because there is a considerable chunk that's taken out again as taxes. We also have to look at the macro factors and micro factors like expectations about the entire market, and the micro factor expectations from the entire industry or the entire portfolio or a particular asset class or a particular stock. So the rate of return assumptions have to look at by being realistic and to study the past of the portfolio assets carefully, because it's going to be the historical data, the past performances that are going to encourage us to include a certain asset into the portfolio. One wonders how much influence should recent stock market returns have on your decisions to make up a portfolio. There are mean reversion arguments. There are also stock returns involve considerable risk. That is very understandable. Also the fact that the probability of 10% return is 50% regardless of the holding period. But if you're looking at returns higher than 10%, the probability would reduce. And if you're looking at returns lesser than 10%, there will be considerably more probabilities. We have by now also concluded that expected returns are not guaranteed returns. Expected returns are different from realized returns. While constructing the portfolio, we have to use an investment policy and to understand market expectations and to choose a particular portfolio asset to be included in diversification. We must understand what sort of securities would then be eligible to be inducted into a particular portfolio. The reason I'm using the word particular portfolio is the need requirement for individual investors will be very different from each other. So we have to have different portfolios, and Markowitz provides an excellent model for us to look at while constructing a portfolio. We use optimization procedures to select securities and determine what is to be their weightage in the portfolio. The proportion of each asset in the portfolio is going to be different. We have to look at the different asset allocations, which would maybe include cash, bonds, foreign exchange, derivatives, common stocks, but there has to be a difference in allocation cost differences, because that will also result in a different result of the performance of the portfolio. So you have to look at factors that need to be considered. The consideration should be on return requirements, on risk tolerance, also on time horizon, and particularly the age of the investor. There is going to be a different level of need from the youngster, from the middle class, from the senior citizen, depending on their responsibilities. Younger generation might have longer time horizons, senior citizens may have lesser risk tolerance, and the middle of the line investor would be able to blend both. He might have the time as well as the risk tolerance as well. So strategic asset allocation has to be done, in which simulation procedures are used to determine likely range of outcomes associated with each asset mix. Establishes long-run strategic asset mixes, and then we can look at the tactical asset allocation. We're talking about strategic asset allocation and tactical asset allocation, in which you can change assets by changes in expected returns, and we can look at it with the market timing report. The market timing can be a good approach by finding out what is the right time for one investment to mature and get out and put in another investment which is ready to mature. It is also about timings. It's about what asset classes you're going to put into the portfolio, and it's important to understand the timing. And then you monitor conditions and circumstances. You have to do that if you're managing a portfolio. So investor circumstances can change for several reasons. That has to be also kept in mind. Wealth changes affect risk tolerance. Investment horizon changes. We can also see a liquidity requirement change for an investor. We can look at the tax circumstances. Also probable is the regulatory considerations. Not to forget about the unique needs and circumstances which are prevailing at all times in the stock market and at all times with an investor. The only thing that keeps changing is time. The only thing that keeps changing is need. The only thing that keeps changing is circumstances. These all have to be looked at with the perspective of the investor and the perspective of the capital market, and how we can blend the two of them and find out the middle of the line road to have an optimal consideration for a better portfolio management and return. One of the ways that you can improve performances is by adjusting portfolios, and portfolios not intended to stay fixed can be looked at. The key is to know when to rebalance. The key word is when to rebalance. The word would then be timings and rebalancing. but there is a cost involved in rebalancing, which would mean more brokerage commissions, maybe price fluctuation because of time difference in buying and selling a product, or time involved in deciding how and when to trade. The cost of not rebalancing involves holding unfavorable positions in the portfolio. Maybe you'd be watering the weeds, plucking out the flowers when it should be the other way around. To measure the performance of whatever we've done in a portfolio, we must understand this allows measurements of the success of the portfolio management or the portfolio manager. The key part of monitoring strategy and evaluating risk has to be looked at, and it is important for us to understand those who employ a manager, those who invest personal funds. You have to find reasons for any success or find reasons for any failure. And then only we shall be able to continue with the performance management of a portfolio management and a portfolio itself. Because these are all time-constrained portfolios, time-constrained managers to manage the portfolios. There will be other performance measurements having to be done. We have to look at these if you need to continue with portfolio management. The question then would arise, how should portfolio performance be evaluated? What are the benchmarks that you're going to look at to evaluate the performance of the portfolio? Bottom line issue in investing. That is the answer we are all looking at, because the reason why we invested was obviously looking for a return. So that is really the bottom line. What should portfolio performance and how should portfolio performance be evaluated? Because that's what we are going to be looking at right now. Is the return after all expenses adequate compensation for the risk that somebody has taken? What changes should be made if the compensation is too little? Or performance must be evaluated before answering these questions. You have to understand all these things have to be looked at if you're looking at a good portfolio result onto the looking at the financial aspects, the financial risk and reward trade-off. Why should we be taking so much risk if there's no sufficient compensatory return as far as investing in the capital markets is? Now, the importance of evaluating portfolios is not that we're looking out at faults. We're trying to look at how we can improve performances of the asset classes in the portfolio. What could be looked at is the right blend of asset classes, the right time horizon, the right timing of investing, rebalancing your portfolios, reevaluating your portfolios, putting in growth and investment stocks, putting in value stock, looking at the fixed income products, looking at variable income products, putting in a little liquidity, and we can have a wonderful portfolio mix. But we have to look what our requirements are. How much returns are we looking at? The requirements of a gentleman or a person who's invested would be lesser if he's investing his own monies. The required return would be more for somebody who's borrowed money to build up a portfolio, because he's got cost to pay on the borrowed money as well. There are several considerations that have to be taken. Without knowledge of risks taken, little can be said about the performance. We have to balance risk and return, risk and performance. Risk tolerance and performance of the portfolio has to be evaluated as one single entity. Intelligent decisions require an evaluation of risk and return. You have to evaluate both of them. Risk-adjusted performance is best. Remember, we've talked all about it again and again and again, that risk is unavoidable, risk is manageable. If you're looking at risk, we're looking at something that can be managed to the best of the ability, and then look at what we're going to get in return for taking a particular quality or quantity of risk. We have to outweigh the probability of risk with the returns that we shall eventually be getting, which again would be different than expectations. Realized returns would be different from expected returns. The risk-return trade-off has to be evaluated and relative performance comparisons have to be done. Benchmark portfolio must be legitimate alternative that reflects objectives. So we can have a portfolio that has been giving us optimal measures of performance and then evaluate each portfolio with the relative benchmark. Remember, we are going to compare the benchmark portfolio provided it is falling in line with the same benchmark required portfolio valuation model in which the time horizon is the same, the value horizon is the same, and then we can obviously compare the two. The benchmark decision is important because you have to look what is going to be the benchmark. We look at stock in comparison with the benchmark of the market index. But if you're looking at portfolios to be evaluated, there has to be a model portfolio with which you can evaluate and look at the relative returns of the benchmark portfolio and the portfolio that you're evaluating. One of the considerations that you have to understand is that the one and only objective of investment is to get a return. So evaluation of portfolio manager or portfolio itself is another question that we have to look at. The portfolio is going to be managed by a portfolio manager. So you have to manage the portfolio, you have to manage the portfolio manager, and then evaluate the manager and the portfolio itself. Obviously, the manager is responsible and will be rewarded or penalized for whatever results have been performed under his guardianship of the portfolio. We have to evaluate both, so portfolio objectives and investment policies would matter. And constraints on managerial behavior will affect performance. The question then would be, how well diversified during the evaluation period has the portfolio been? Adequate returns for diversifiable risk have to be evaluated again. The considerations of looking at diversification of the portfolio is important. Remember, it's look before you leap. You choose the portfolio prior to actually putting your money where your mouth is. You have to look at these considerations in getting the eventual result. We have to put in a good thing inside the portfolio, otherwise it would be a classic case of garbage in, garbage out. You have to have an excellent analysis of the portfolios that you're going to be blending together. Once again, the consideration has to be at the age of the investor, the financial liquidity strength of the investor, the cash flow requirements of the investor, the risk tolerance of the investor. These considerations would then help you understand what sort of return would then be ideal for any particular institution or any particular individual investor. These considerations, when looked at minutely, would help us evaluate a portfolio in a much better, in a bigger canvas by understanding the spirit of the portfolio manager, because everything he does, all constraints of the manager's capacities are going to affect the portfolio's results. There are return measures that we have to look at. There has to be a change in investors' total wealth positively over an evaluation period. Obviously, when somebody is invested in a portfolio, is expecting a positive change in his wealth. We have to look at the ending portfolio value and the beginning portfolio value. Have a look at your equation appearing on your screen, in which VE is the ending portfolio value, VB is the beginning portfolio value, and then you can have the difference of VE minus VB divided by VB, which is the beginning of the portfolio value, and you'll have a result of the investor's total wealth improvement, hopefully. Assume that no funds added or withdrawn during the evaluation period, and we do not look at the timings. If not, timing of flows will then be important. So you look at, it's very simple to look at a portfolio, what you put in, what the end result is in financial terms. see the difference, look at the percentage gain, and you'll find out what has been gained, what sort of a yield you had over a particular period of time, say 1 year, 2 years, or 3 years, depending on the time horizon. It's fairly simple to understand that the equation will simplify things for you, because these are going to help you understand portfolio valuation and the measurement of the returns of portfolio, which will also help you understand whether there's been any gainful investment in a portfolio. Unless we measure, unless we evaluate, unless we look at the considerations, we must be understanding that portfolios have to be looked as a means of enhancing somebody's capital gains, capital wealth, and his financial status as well. The reason, the bottom line why somebody invests in stock markets. Unless we are able to measure returns, unless we are able to measure and evaluate what has been quality time utilization, we shall not be feeling very satisfied with the performance of the portfolio. The word has always been optimization and optimal results. The word has always been a better result compared to the risk that we are going to take. So the return measures can be dollar-weighted returns or the rupee-weighted returns. So these returns can be evaluated in money terms as well, or we can evaluate in time period as well. But money terms can now be looked at, and it will look at the cash flows during the evaluation period. If we're looking at the rupee-weighted returns, we'll look at the cash flows during the evaluation period. We'll also be looking at the equivalency to the internal rate of return while we are trying to look at measures of measuring returns. The return measures or the dollar-weighted returns equates initial value of the portfolio, like we mentioned, and you saw it on your slide, which would be the investment at an initial state with cash flows or outflows and ending value of the portfolio. That's exactly what I said it in a different way just a little while ago, and you saw that equation on your screen. You were looking at starting point with investments and the ending point with the value of the portfolio. The cash flow effects make comparisons to benchmark inappropriate. So we'll simply look at the end value of the portfolio, compare it with the beginning value or the starting value of the portfolio, look at a positive difference, and that would be a dollar-weighted return or a rupee-weighted return, very simple. We're talking about having more money at the end of the day than we began with, so that we can look at what results have there been by the investments that have been made into the portfolio. So if we were investing something like ₹1 million and you've got now 1.1 million, then you would be understandably looking at maybe a 0.10 million return on the 0.1 million return on your investment of 1 million, and then maybe look at a 10% return evaluation. It is about evaluating returns on your investments. We just talked about rupee-weighted returns. Let's look at time-weighted returns as another method of looking at return measures. So we can look at cash flows during the evaluation period, and which permits comparisons with benchmarks. You can also calculate a return relative for each time period defined by a cash inflow or cash outflow. We use each return relative to calculate a compound rate of return for the entire period. Remember, the interesting part of the portfolio management is that we always look at reinvesting returns into the portfolio to get a better return at a different time horizon. Since time factors will then be different for the initial investment and the reinvestment, so returns will have to be evaluated in different steps, and the process shall continue for the entire portfolio period. It is a probability, if you're looking at reinvestment plans, that we will have to have a look at different time horizons and different set of periods to evaluate the performance of the portfolio. Which would mean that we would be talking about better results actually and be looking at the result of compounding. There is much written on compounding. There is much been talked about compounding. We at this forum have also discussed compounding in detail, and I think that would enhance and really be catalytic in improving your results as far as returns are concerned, because we are putting back all the earnings, which is not a debate right now at this point of time, or putting all your eggs once again in the same basket, putting all your earnings back into the portfolio. But I think it's really a good idea to not consume what you're earning, to be actually be able to find out what your realized returns are going to be. We talked about time-weighted measurements, and we talked about rupee-weighted measurements. So which return should we consider as the better one of the two? Which return measure should be used or decided upon? Different results for time-weighted measures, different results for dollar-weighted measures, and the dollar-weighted measures return appropriate for portfolio owners. Time-weighted returns appropriate for portfolio managers. Look at the difference between the two words. One is about investors, the other is about managers. The managers would like time, the investor would talk about rupees. So then there would be a difference in likeness of a portfolio between an investor and a manager. The manager would want infinite time as far as portfolio is concerned, because he'd get a better result over time. An investor wants money returns, so there is time-weighted return. There is no control over inflows or outflows, and independent of actions of the client. Time helps money managers or portfolio managers more. So one could actually look at time-weighted results. One could look at time-weighted returns to be a better measure of the two. Why? Because you'll get better results over a longer period of time. If you're strapped for time, if you're strapped for cash, you'll probably get an optimal result than you would get in consideration of a time horizon. So we're looking at bigger results in time and maybe lesser returns if you're looking at a fixed time period. Once again, the longer your investment takes to mature, it'll be a much bigger return. And then we are also looking into factors about compounding as well. So compounding helps, time horizon helps, and then you can look at a better measure being the time-weighted measure, which may not be much to the liking of an investor, but I think if it's a sensible investor, he would look at the time horizon as well and then evaluate what the returns have been. To do all this, we also have to look at the risk measures that have to be looked at, the risk which is going to be associated with the returns. Risk differences cause portfolios to respond differently to market changes. It is going to be paramount to understand that risk is going to be one of the key players in returns on portfolios and results of portfolios, and how the results keep changing with market changes. We must understand the total risk measured by the standard deviation of portfolio returns. Standard deviation would be a good measure of finding out what has been the average mean return of the benchmark portfolio and how deviations have really been calculated on the basis of the portfolio that has to be measured. So total risk measured by the standard deviation of portfolio returns is another way. We can also look at the non-diversifiable risk measured by a securities beta. Now you're getting down to the time when you can understand the value of betas and standard deviations. Probably these will help you measure the returns, measure the risk more with betas, and with the risk would be obviously, once again, just quickly, greater than 1 beta, the stocks or the products would be riskier. Lesser than 1 beta will be a safer product to be handling. The betas estimates may vary, but unstable and change over time. Naturally, betas can't remain the same because of market conditions. Market prices are changing. Obviously, betas will change because they're linked with market prices, they're linked with earnings, and then you would look at the volatility factor as well if you're looking at standard deviations. Standard deviations and betas would then be another way to measure risk. We're talking about measuring returns. When we're talking about measuring returns, we should also be talking about measuring risk, and that can best be done by standard deviations and by measuring betas. No risk, no gain, no return, no risk. We have to look at the two. So we must consider a risk-adjusted performance as well. The risk-adjusted performance would be ideal to be looked at through the Sharpe model. This is a Sharpe with an E at the end. That would be SHARPE, Sharpe, for the gentleman who's actually created risk ratio. So the Sharpe risk, the Sharpe reward to variability ratio, RVAR, is going to help you look at the ratios. The Sharpe reward to variability ratio has to be looked at as the benchmark used on the ex-post capital market line. Just focus on the capital market line that we talked about, and we look at the Sharpe reward to variability ratio. Look at the equation on your screen right now, telling you about the RVAR, which is the reward to variability ratio, is equal to average excess return divided by total risk. Risk premium per unit of risk, the higher the better, the higher the risk premium, the better the performance, provides a ranking measure for portfolios. So Sharpe's reward to variability ratio is one way of looking at risk-adjusted performance. But this is not the only way to look at risk-adjusted performances. Just look at the reward to variability ratio, and then we can also talk about the risk-adjusted performance on another platform, which would be the Treynor, the TREYNOR, Treynor reward to volatility ratio. The Sharpe ratio was a reward to variability ratio. The Treynor ratio is a reward to volatility ratio. Just look at the difference between variability and volatility. Sharpe's talking about variability, Treynor's talking about volatility. We look at the Treynor's reward to volatility ratio, which distinguishes between total and systematic risk. Have a look at the screen and have a look at the equation on your screens right now. The Treynor reward to volatility ratio tells you and distinguishes between total and systematic risk. So RVOL, for short, for the longer version of the name, is equal to average excess return divided by market risk. Risk premium per unit of market risk, the higher the better the performance, and it implies a diversified portfolio. So you now have actually two variabilities, two different ways of, evaluating the risk-adjusted performance of portfolios, the RVAR and the RVOL. Don't confuse the words volatilities and variabilities. Sharpe talks about variability, Treynor talks about volatility, and volatility ratio implies a diversified portfolio. Since we looked at betas, we've looked at standard deviations, we've just talked about volatility, and we just talked about variability. We have to find out what these measures are going to do. So is it going to be RVAR or RVOL, or reward to variability or reward to volatility? Is it Sharpe versus Treynor? Depends on the definition of risk. Depends on the definition of risk. If total risk is best, then you use RVAR. If systematic risk is best, then use RVOL. So you can combine total risk with RVAR, variability, or systematic risk with volatility. If portfolios are perfectly diversified, optimally diversified, rankings based on either variability or volatility are the same. Differences in diversifications cause ranking differences. Variability captures the diversification part of a portfolio. So you have to look at diversification. If you're looking at performance, looking at risk, then you can look at the variability ratio. Or if you're looking at diversification, you have to find out whether they're the same or not. Diversification will make rankings based on RVAR and RVOL to be the same. You must understand that total risk has to be looked at through RVAR and systematic risk through RVOL. RVOL once again is short for volatility, VR short for variability. Sharp is concerned with variability ratio, Traynor is more towards the volatility ratio. We looked at measuring portfolio performances, we looked at measuring risk-adjusted results. How about measuring diversification? If we look at diversifying things, and we need to understand what results have been produced by diversification, we have to find out how correlated our portfolio's returns to market portfolio. The portfolio that you're managing, the portfolio we are talking about in comparison to the market portfolio, the benchmark. So the returns have to be looked as R2 from estimation of the results. Have a look at the screen, have a look at the equation appearing right now. R2 is the coefficient of determination, excess return form of characteristic line. And the lower the R2, the greater diversifiable risk and the less diversified. You have to look at how diversified the portfolio is, what has been the results of the returns, and how good has been the excess return from characteristic line. These are understandable when there is a lower R2, greater the risk. And we're talking about diversifiable risk. When we measure portfolios, we have to measure each and everything. It's not just the results. It's the product class, it's the variability of the product, it's also the time factor that we have to consider, and also look at the measure of diversification in measure of reward in comparison to the risk. We haven't talked about Jensen's alpha, talked about betas, but how about talking about Jensen's alpha as well? Is measuring the portfolio as well. We're measuring the diversification as well. If you look at your screens, you'll find out another equation, and the estimated alpha coefficient in the equation will be a means to identify superior or inferior portfolio performances. Jensen's alpha will let you estimate the performance of a portfolio. The capital asset pricing model implies alpha is 0 and measures contribution of portfolio manager beyond return attributable to risk. If Jensen's alpha or alpha is 0 and alpha is greater than 0 or alpha is less than 0 or is equal to 0, performance can be superior, inferior, equals to market risk adjusted. So if alpha is greater than 0, we're looking at superior performance. If it's less than 0, we're looking at inferior performance. And if we're looking at exactly 0, then we're looking at an equal to the market risk adjusted performance. So you look at through Jensen's alpha at better performances, weaker performances, and performances equal to the market risk adjusted for all the results. So you can look at the measurement or diversification. You can look at the diversification as itself. You can measure the risk. You can measure the reward. You can measure the portfolio's results. You can measure the portfolio manager's results. You can measure everything based on different methodologies. But there are maybe measurement problems. What can these measurement problems be? Maybe we're talking about performance measures based on capital asset pricing models and its assumptions. Is it riskless borrowing? What should market proxy be? These are questions that keep coming into one's mind when there are problems regarded to measurement. If not efficient, benchmark error can be there. Global investing increases problems maybe. So what is going to be other problems related to measurements as well? How long is an evaluation period the right period? I think one can look at 10-year periods to be a good idea. 10 years really brings in 2 cycles, 2 5-year plans, maybe 2 term governments. 10 years is not a bad idea to look at for evaluation periods, because these evaluation periods are going to be time weighted. Once again, it brings us back to the methods used in evaluating performances, whether they're going to be time weighted or whether they're going to be rupee weighted, and we found that probably it would be a good idea to look at the time weighted measurements. Right now, again, the same topic is being discussed, in which one could look at a 10-year period when you're looking at evaluation periods. So these 10-year periods will probably give you better results than looking at maybe 3 years, 5-year or 7-year periods, and this would then help us understand and avoid different evaluation problems as well. These, interestingly, are going to be of great value when we talk on terms of measurement problems. When we look at measuring portfolios, when we look at the different aspects involved in the measurements, we must understand the performance measures based on capital asset pricing models and its assumptions. And remember, it was basing its assumptions also on the fact that it was looking at factors of riskless borrowing and lending. But there are other evaluation issues included as well when we're talking about measuring and evaluating. Performance attributed to which seeks an explanation for success or failure. Since we're looking at reasons for evaluation results, we have to look at the performance attribution which is being sought in. Analysis of the original investment policy and asset allocation decision is one evaluation issue. Another is analysis of the industry and security selection, security as in stock. We may be talking and looking at issues related to the industry or issues related to the security, and then there can be a benchmark confusion, or maybe the benchmark is not right, the benchmark selected to measure passive investment results. That could be a kink in the armor as well. We would be having a boogie. We're looking at different benchmarks that might not be appropriate. So differences due to asset allocation, market timing, security selection can all be issues in evaluation of the portfolio's performance. There is no one set of valuation methodology. There is no one issue related to portfolio valuation. There can be numerous issues that can come up and hamper valuation methodologies and hamper results as well, by maybe not selecting the right measurement tools, by maybe not selecting the right benchmark to measure the portfolio, by maybe not being able to understand variability and volatility in relation to total risk or diversifiable risk or total risk or systematic risk. So you have to keep your eyes and ears open and actually trying to evaluate the performance, not just based on time, but also look at the aspect of the returns involved as well. I did mention, yes, a time-weighted return period horizon would be a much better way of evaluating performances, but that does not mean that you do not look at the value returns or the capital gains or the rupee returns on your investments. We also have talked a lot about the risk measures that are taken into account as well. And then we looked at the aspects of talking about standard deviations and betas in evaluating what is going to be good risk or bad risk or selection of portfolio products inside the basket. Since we have determined that each individual stock is going to affect the portfolio, of course, not to the extent that any one single product is going to overcome the result and completely change the results of the entire portfolio, because that can't be possible, because there is a certain percentage proportion that you've allocated to each asset class inside the portfolio. It's not quite likely that one product of a portfolio is going to disturb the entire result of the portfolio. Yes, it will dampen the result, but it will definitely not alter the result altogether because of performance from the proportion restrictions on the portfolio that you have decided before you actually build up the portfolio. What other valuation issues can arise will all depend on the type of portfolio, will all depend on what sort of products are we looking at. We must understand that we have to look at the industry, what sort of products we found in the industry to be analyzed. We also must look at different products in different areas that need to be understood as such. Remember, when we're talking about investment analysis, when we're talking about investing in the capital market, when we're talking about investing for a certain period of time, the bottom line is improving your wealth. Which brings us to the basic aspect, why did we invest at all? Or what should we invest? So when we're talking about issues in evaluation, we have to go back to the period when we talked about different asset classes or different categories in which we can invest. And we talked about the process in which we selected different components or asset classes in a diversifiable way to be included in the portfolio. And I hope you remember, we talked about basically two real classes or two real assets or financial assets. We talked about real assets and we talked about financial assets. We talked about real assets being like land, and we talked about financial assets like being stocks and bonds. And while we're talking about financial assets, we talked about three different categories of stocks and bonds and derivatives. So what we were looking at was diversifying risk, diversifying the assets in the portfolio, and one, we can probably look at equity investments. Two, we can look at fixed income investments. Three, we could look at the derivative asset class as well. If we were looking at equity investments, we're obviously talking about the common stock. If we're looking at fixed income investment, we're obviously talking about preferred stock and bonds. And if you're looking at the derivatives investment products, we're probably looking at futures, forwards, swaps, options. These will make good blend of portfolio that you can look at while looking at different assets, different products into the portfolio. Which then again brings us to the question, what was this all about? Well, basically, we began with investment analysis, and we then ended up with the portfolio management. And when we were talking about portfolio management, we ended up with valuation of the performance of the portfolio itself. The bottom line once again was what? The reason everybody invests, since we're talking about investments, we're talking about inflows, we're obviously looking for expectations in outflows as well, which would mean a valuation. If you're talking about putting in your monies, you're obviously talking about taking them out as well. If you're talking about taking out money, then the understanding would be we're looking at more money. And if you're looking at more money, we're looking at better results. So why do people invest then? I hope you have not forgotten, reason people invest is for capital gain. One of the reasons people invest is for capital gains. To improve their status financially, to improve their wealth, to fatten up their wallets, to bring some happiness into your life with more money to spend, more spare cash available to you, is one of the prime reasons people invest. Another reason why people invest is for supplementing their income. When we're talking about investments, we're not only talking about finances, It could be probably be human resource investment as well. It could be investing your time for returns as well. But let's now focus on investing monies first. So you can be investing monies for supplementing your income. How? You can do that through dividends or interest that you shall be earning on your investments. So we can look at capital gains, the reason we need to evaluate the performance of the portfolio, or you look at the dividends or the interest that will be coming to you from products inside the portfolio. And there's too much excitement when we're talking about investing in capital markets. The excitement to keep coming back to the portfolios, keep coming back to the stock market. So if you look at reasons why we need to measure, it's quite simple as vanilla. We need to understand the reason we need to performance evaluate is what have we put in and what are going to get in return. And we do it in relationship to a time period, which is better than relating it to dollar returns. So we look at the return performance better in terms of time than in terms of rupees or dollars. This was all about investment analysis. This was all about portfolio management. It's been wonderful talking to you about investment analysis and portfolio management. We'll be talking on different topics in the coming lectures, and you be in touch. You keep looking at the lectures. You keep hearing them. You keep listening to what I'm saying. You'll hopefully be much better involved with capital markets. Thank you very much.